Well, good morning, good afternoon, everyone. I'm Elliot Kallen. I am CEO of Prosperity Financial Group, and I would like to welcome you to another episode of Meet the Expert. Very exciting. This is something we don't do a lot of, but we have a real expert on about Bitcoin and blockchain and what is this? And that's gone from $50-something thousand, $60-something thousand a coin to $20,000. And should we buy it? Is it going bankrupt? Is it the future? Is it the past? Lots of great questions. If you need to reach me, I'm at 925-314-8503. That's my direct line. It's Elliot, ELLIOT, at prosperityfinancialgroup.com. And we're at www.prosperityfinancialgroup.com. And you can make an appointment using my calendar that's on the website. So let me welcome Ben McMillan. Welcome, Ben.
Thank you, Elliot. Great to be here.
Thank you. And great to have you. Just a quick introduction of Ben, and I'll make it fast because people want to hear what you have to say rather than who you are. And that is that he's got great credentials. He's founder of IDEX. That's obviously the company that specializes in Bitcoin. A lot of credentials after his name and masters and so forth. He's been on Bloomberg. He's been on Fox Business. He's been on CNBC. I don't even know what other shows you've been on. Maybe you've been on Oprah. I don't know what other shows you've been on. But you truly are an expert in what some perceive as the future of exchangeable currency out there. So why don't we start some basic things, if that's all right with you, Ben? How does Bitcoin, what is it? How does it work? How does the average person get hold of it? And then the volatility, let's talk about that too. So let me turn it over to you for a moment, and I might interrupt you with more questions.
By all means, absolutely. So kind of the simplest way to think about, Bitcoin or blockchain technology in general is just a decentralized network of computers. So the question is, all right, what's so great about that? There's a lot of nice properties to that. So if you think about, Google Cloud or Amazon AWS, the ability to have computing capability that's decentralized, so it's, tens of thousands of computers all over the globe, that can send transactions back and forth is nice because it's very robust. It's very durable. One of the reasons, a lot of people in recent years have gotten excited about blockchain technology is, when there's been other events where centralized services have gone down, blockchain-based technology has stayed up. And so, it started, as kind of among early adopters in technology that first, saw the promise of this technology. It started to now go mainstream. Now, a large part of that is because of the financial component too. Bitcoin, of course, was early on in being seen by many as competition for money or currency. And so that brought in a wave of kind of, speculative buying. But it is important to, detach the underlying fundamentals from, the speculative price behavior, much in the same way that commodities, there's intrinsic value into, for wheat or copper, oil, but, the price at any one time can be excessively volatile. So you've got kind of, two competing camps here. So, Bitcoin, I'll wrap that thought by saying a good way to think about it is really kind of the 90s era. For those of us that remember that, the idea of the internet was still in its nascency in kind of the early 90s, mid 90s. And then we had the .com bubble where, any business with a .com at the end of it, went to the moon. We had the .com bust when, people realized that just putting a .com at the end of a bad business doesn't make it a better business. Pets.com was still a bad business model. And so everything got, the baby got thrown out with the bathwater, so to speak. And, now that's kind of what, crypto in general has been going through very recently with, this kind of boom and then bust is, the speculative, excess working its way to a fever pitch. Now the baby's coming out the bathwater, and people are going back to the roots and looking at the technology and, starting to build from there. So, anyway, that's, at a high level, that's why people are getting excited about Bitcoin. That's why, a lot of, kind of technology focused groups and, bigger players are starting to look at this as a better way to send, payments internationally, a better way to, run decentralized services, even things as complicated as exchanges or banking functions can be done in a decentralized way, which has a lot of nice properties to it. So it's an area of excitement, but again, as I said, it's one where it's seeing kind of speculative excesses.
So just on that note, if we could, before we get into good use of it, there are some companies that aren't going to survive. And And by the way, we're talking with Ben McMillan, and you've got an interesting degree, econometrics from the London School of Economics, as my son was there too. So I have great respect for these think tanks.
Oh, excellent. Yeah.
Yeah, a bunch
Very
of
good.
MIT geeks there now in London, all studying on how to change the world. But it gives you a lot of gravitas on the subject, and that's why I brought that up. But looks like Coinbase may go out of business. Other exchanges, Ethereum, are they going to survive? There's Doge that was created as a joke. And we've seen Elon Musk kind of use it as a joke and things like that. So there's a lot of fat in the market. How do you understand that?
That's a good way to put it. And again, this goes back. That's why this is why I like the .com analogies so much, is because, you look back to that era and you had, good companies like Amazon.com, right alongside, like I said, Pets.com. And that's what we've got now. Now the tide, this tide is going out. The Fed obviously is pulling back on liquidity. That makes capital much more discerning, not just within the crypto spectrum, but everywhere, high value growth stocks. I mean, you look at, the ARK ETF is down big year to date because, again, all of a sudden capital is starting to be more discerning in terms of where it's going to place its bet. Growth is getting repriced. And so, within the crypto market, yeah, that's absolutely right. There's a lot of companies that are not going to make it. I think, things like Coinbase and some of the bigger ones are, they're big enough and they have a big enough footprint that I'd be hard pressed to believe they go out of business in the same way that Lehman Brothers did. There's probably some big strategic out there that would prevent that from happening. But groups like Celsius, I mean, that's been in the news recently. Luna, to back up about a month, when we started seeing kind of the real stresses in the crypto market unfold, there was a protocol called Luna, which was its own blockchain. And it was poorly constructed from the beginning. It was one that, had a lot of criticisms early on. Some of the behaviors by the founders were, very kind of scammy or seemed scammy. A lot of people, were worried that it was kind of a glorified pump and dump. And, that was a project that, raised a ton of money, did well as long as the, music was playing, so to speak. But as soon as the Fed started pulling liquidity out of the market, it was a house of cards that just collapsed in on itself. And so, that was one that was, an outright, if it wasn't an outright Ponzi scheme, but it was structurally very similar. It required money to keep coming in to stay afloat. Fast forward, now we had Celsius most recently. It was a very big centralized company paying out 20% APR on crypto loans. So that's one where you could buy Bitcoin through them or Ethereum, and you could lend it out and they would pay 20%. Well, the way they were able to do that was they were borrowing, VC money and just literally subsidizing that rate. Well, that's obviously not a sustainable business model. That's one, again, when liquidity is cheap and easy, you can get away with it. And, that was part of their play to kind of buy users. But once liquidity becomes more expensive, that's a business model that goes to zero. And that's what we've been seeing. They've been a stressed seller in the marketplace recently. And so, they've needed to get a bailout or they're looking for a bailout. So you're going to have companies like that do go to zero. But now on the other end of the spectrum, look at the protocols themselves. So, Coinbase, Celsius, these are centralized companies. These, they're not decentralized protocols. They're in the crypto market, but they're regulated and they have a PO box and all of that. When you look at something like Ethereum or Bitcoin, those are actual just blockchains. And so there's no centralized company that quote unquote owns that. It's purely decentralized. And so that's a lot more durable. That's a lot more robust. That doesn't mean that the price can't get too high. And again, that's what we've seen. The market is, repricing Bitcoin, but it does mean that it can't be, regulated out of business or out of existence. So there's a durability component there that's appealing. And that's one of the reasons, people have kind of rallied around the idea of decentralized blockchain technologies. Is it because you don't have to worry about that counterparty risk that you might with a Coinbase or a Celsius or even an IDEX or whatever, no matter who it is. So that's a key distinction.
Okay, so this is confusing and it's high level stuff that we're talking to clients and potential clients on and friends. So I want to get back to regulation, and I want to talk about afterwards the dollar. But let's talk for a moment about supply chain versus blockchain. We have a major supply chain issue around the world. I don't know if that goes away unless we have a worldwide recession. Maybe we're going to have that. Who knows? But there are a lot of people who think that the answer to the worldwide supply chain problem is locked up a little bit in Bitcoin, that they can solve this. So tell me about that.
I think blockchain technology can absolutely help. Whether it can solve it in one fell swoop, it's unlikely. Supply chain issues are highly complicated. Not the least of which is competing kind of political considerations that are completely exogenous. A unilaterally declared war, for example, in the middle of Europe isn't. Bitcoin isn't going to solve for that. But where it can solve, and where you've seen some of the early work on blockchain technologies by some big name companies, by the way, is in logistics and supply chain. And again, if you think about being able to just at the simplest level, being able to cut out the middlemen. If you look right now with supply chains, one of the things that's like the old, actually, this was on one of my game theory exams at the London School of Economics is, how do traffic jams happen? And, it's game theory where if, one person slows down the road to see what's happening in the other lane, that has ripple effects that are amplified. And so that's how you get, 10-mile traffic jams when just one person is stopping for a split second at a time. Supply chain logistics is very much the same way. You've got a lot of different interconnected links. And if just one of them jams up, that jams up the next one, and it's an exponential effect. Well, if you can automate a lot of that and remove the human component, or embed that in self-executing smart contracts, which is what blockchain technology does, you can remove a lot of the middleman layer and really kind of streamline different supply chains. Now that there's a lot to be built out there, but the key is that it is being built. One of the big things we always get the question, how do you know, Bitcoin and Ethereum aren't zeros, they're worthless, they don't do anything, everything is theoretical. And the answer is, well, 10 years ago, this was all theoretical. And I remember buying Bitcoin 10 years ago. I remember mining Bitcoin 10 years ago. And it was, everything I'm talking about now back then was very much a theoretical use case. It was a could happen or might happen. Now fast forward, and it's really been the last kind of 24 to 36 months, 2 to 3 years, we're seeing applications, start to solve this. Now there's a long way to go. It's not going to solve supply chain issues, this year, but it is being developed. And so that's a key consideration as it relates to kind of blockchain or Bitcoin and Ethereum, is that the use cases now are no longer purely academic. They're being built. They're being built and deployed in the real world. And you're seeing companies actually start to deploy them. Disney, for example, is using a blockchain called Stellar for some early logistics exercises. IBM has a deal with Stellar for something similar. And so you're starting to see big companies turn to this, and it's not for marketing purposes. It's because they've got problems they want to solve. So yeah, I think to answer your question, I think blockchain technology will absolutely help the supply chain issue. It's going to take time. It's got to be built. It's not going to be, a one and done answer, but I think it is, much in the same way that, back in the early 90s, it wasn't yet clear how the internet was going to affect all of our lives. Now, of course, fast forward, 20 or 30 years, and it's ubiquitous. We can't imagine life without it. We could very well see a similar progression with blockchain technology.
So there are some people on that same blockchain technology concept who the prognosticators of the world that say, when we get rid of the middleman, you're eliminating the need for Google and all these servers out in the marketplace, because computers will talk directly to computers. And it's hard to imagine a world without a Google or Microsoft or all these millions of servers talking to each other. How do you see it?
Well, I think it's probably going to be a hybrid, and this is the big, if you've heard the term Web3, that's what they're referring to, is basically a decentralized, internet, one in which the Googles, would be, disintermediated by a global network of peer-to-peer computers. I don't think it's a one or the other. I think we're going to have hybrid approaches. There are a lot of benefits to decentralized blockchains, but there are some drawbacks. And so there is a place for both. There are some of the benefits of centralized servers, centralized computers, are speed and scalability. You sacrifice on the security, and you sacrifice on the kind of other pieces of the puzzle. But I absolutely, I think it's inevitable that blockchain technology starts to take away some market share from the Googles of the world over time. And that's, you've seen the idea too, and you'll see more of this. Like I said, the Web 3.0 concept, one of the kind of strong pillars of that thought is people owning their own data. One of the big issues, with privacy rights recently has been, these big companies, Google and Facebook, they actually own our data, they monetize our data, and the consumer has no say in that. So one of the big promises of a decentralized internet, what they're calling Web 3.0, is that users can own their data. And so it wouldn't be in the hands of any centralized entity, it would be in the hands of the users. And we could choose, who sees our data, how we want to monetize it. And so, I think it's going to be a hybrid world. There's going to be a place for both. But I don't see any state of the world in which, Web3 or blockchain doesn't take, some market share from the Googles and the Facebooks of the world, which is why you're starting to see these guys, make a land grab in the blockchain space. I mean, Facebook, renamed their name to Meta, for example, to make a metaverse play. I mean, these guys are smart. They see where the puck is going, and, they're trying to skate there, before everybody else. So.
Well, I like the hockey metaphor. We're talking with Ben McMillan of IDEX. He's the founder of IDEX, and we'll get to that in a moment. If you want to reach me, I'm at 925-314-8503. And Elliot, ELLIOT, at prosperityfinancialgroup.com or www.prosperityfinancialgroup.com. So let's keep going, Ben, if we could. We have a few more minutes here still. Let me talk about the dollar, the competition from the dollar. So I look at this, and I have been wondering, as somebody who's been in the financial advisory business for 29 years, almost 30 years now, giving people advice on money and investments and retirement, that I'm wondering why the U.S. Treasury has allowed Bitcoin to even exist and get to the point that it's come to, and why they haven't come up with their own version of the crypto dollar, because you and I both know that China has aspirations for taking out the world and being the only world player. And so in crypto, they want to have the only world currency. And they have trillions of dollars in their currency, but trillions of dollars that can make a difference. And they've got a Navy and other places that can make a difference on there. So let's talk about competition from the US dollar. Is it real competition? Are we going to have a cryptocurrency? How does that work with Bitcoin? Does that clear the space even more from and gets rid of other currencies too?
Yeah, no, I mean, I think you hit the nail on the head. I mean, I think that's exactly right. That, the Fed originally looked at this, or the regulators in general originally looked at this. They didn't like it. They didn't want competition. But again, because it's decentralized, they can't take it down. And so they quickly realized, they saw what China was doing, and they quickly realized that, we gotta come up with our own, central bank digital currency to stay relevant. And I look at, Chairman Powell's comments this past Friday, I think were very telling. And this didn't get a lot of play on the media, but he said at a banking conference that, the U.S. needs to have a central bank digital currency for the dollar to maintain its preeminence. So he's already looking at kind of a post-dollar world. I don't think it's any surprise that, the Middle Eastern country, Saudi Arabia, is now starting to negotiate, potentially moving away from a dollar-denominated oil. So the U.S. regulators are looking at this and saying, the digital currencies are here to stay. We can't get rid of them as much as we would like. China's already beat us to the punch in launching their CBDC. Saudi Arabia is about to move away from dollar-denominated oil. We need to get in this game. It's not unlike Facebook. They had a great moat for a while. Blockchain currencies is going to take that away. And so that if you can't beat them, join them. So I think we'll see. I think we'll certainly see a central bank digital currency. The question is when. I think it's probably sooner than later. The Fed has had a pilot project with MIT for several years now in terms of developing blockchain technology. It's totally public. It has not been well advertised. That may or may not be by design, but you can go and Google it. You can see the papers. I mean, they've done a lot of work in terms of developing a pilot for what a Fed coin or a CBDC would look like. I think that's only accelerated now. And I think Powell's comments on Friday hint at that. I think that'll be good for. I think that there's kind of two schools of thought here. I think regulation around stablecoins in general is going to be good. I think a central bank digital currency will help that. It'll ultimately help increase adoption. It'll help be an on-ramp, a safe on-ramp. For people that are nervous about crypto, they don't want market risk, so maybe they don't want Bitcoin or Ethereum, but they're skeptical of private currencies, which are all stable coins right now are technically private currencies, and so you've got to really trust that the peg maintains. If there could be a Fed coin, that's backed by the full faith and credit of the U.S. government, that could, I think, go a long way towards kind of increasing the audience for crypto, ultimately getting them, on board. And then what does that do to Bitcoin and Ethereum and the existing cryptos? I think it sits alongside them. I think there's going to be an exchange rate, just like there's an exchange rate now for US dollar and Bitcoin, or, Russian ruble and Bitcoin, whatever it is. There's going to be a digital version of the US dollar. That's this Fed coin. It just, comes with it all the programmatic aspects that, people like. Just imagine getting your tax refund directly. Your tax refund could, in a pure blockchain world where all your spending was captured, your tax refund could be as easy as, just hitting your wallet. Or you look at stimulus payments, you wouldn't have to put checks in the mail, that could just hit your wallet. So there's a lot of appeals to having kind of digital currency. And again, I think maintaining dollar hegemony as long as they can is one of the big ones.
And you think there's room if we do have a dollar and a Chinese currency there, you think there's room for Bitcoin too? People would actually say, I'm going to deal in a third party, but I have a sovereign Bitcoin, sovereign crypto?
Well, yeah, because Bitcoin is still going to have value independent of the Fed. So the Fed coin is going to be, the Fed isn't going to have a cryptocurrency that competes against Bitcoin or Ethereum, because they're just going to have a stable coin, and they're, with it, it's going to be, there are concerns with that too. One of them is, privacy rights. People have said with the Fed coin, they can see exactly what you're doing, how you're spending. In fact, a lot of people don't know, but recently in China, during their zero COVID policy, they would lock down wallets that they thought were violating COVID policy based on where they were spending their e-renminbi. So if you were spending their digital coin at a place or a time you shouldn't be, they could just shut your wallet down. Whereas, so a lot of with physical cash, you can't do that. So there are privacy concerns around central bank digital currencies. There's also inflation concerns. The central bank digital currency, is going to inflate at the same rate the dollar is. So for people that are concerned about purchasing power and hyperinflation and things like that, the central bank digital currency doesn't solve that. That's one of the appeals of, these decentralized currencies, is that nobody can flip a switch and decide to, make more Bitcoin. I mean, there's a predetermined amount. There's only ever going to be 21 million in existence. And, that is what it is. And as long as that blockchain has utility, owning a piece of that blockchain, is going to have utility as well. And so I think you're going to start to see specialization. You're going to see certain blockchains optimized for certain things. Bitcoin is going to be one, Ethereum is going to be one. And then, you're going to have the various central bank digital currencies, which are going to be just digital arms of those existing currencies. So I absolutely think there's a place for both. I think the race really is between the Fed coin and the other central bank digital currencies. So, their race isn't necessarily against Bitcoin or Ethereum, it's against the China yuan.
So there are some professional ball players that decided they wanted to get paid in Bitcoin. So it wasn't too long ago that Bitcoin was over $60,000 a coin. And today it's 20, give or take, right? So if I've negotiated your contract at 60,000 market rate, which was at that time 60,000, and I'm paying you $5 million contract based on $60,000 a coin, and today it's worth 20. Did I just get a 2/3 haircut?
Yes, you did. And that is why I reached out to every single one of those ball players. I reached out to the mayor of New York. I reached out to the mayor of Tampa, who also said she wanted to take her payment in Bitcoin. And I said, think twice about that. And if you do, take it in our risk managed Bitcoin fund, because it's gonna preserve value during drawdowns. So yeah, it is something. I mean, people, this has always been our issue is, it's easy to get excited about blockchain technology, but also understand price is something different, and price is going to be all over the place. Is a speculative asset class where 50% drawdowns are a way of life. And, I don't have to tell you that, when you get into the math of drawdowns, anything at, 50% or above, you've got to make back, you've got to double your money just to get back to break even. In fact, that's where we are right now. The Bitcoin is down, from all-time highs, Bitcoin is down well over 50%. So if you rode that down, you need it to go, back up, at least 100% just to get back to break even, where, if you, for example, our risk managed approach is this year is down about 24%. So, that's in line with 20-year bonds. So, it doesn't need to, you don't have to spend as much time digging yourself back out. So we are firm believers in taking a risk managed approach, either you're, a group like ours, dollar cost averaging, sizing it appropriately, whatever it might be, but be cognizant of the risks, because the price risks, because it could be a good technology, but it can also be very speculative. And again, this is like, look at the ARK Innovation ETF. I mean, there's a lot of companies in there that are probably, way overpriced. But they've got good, they're good businesses. They're going to be around, but the price just got way ahead. And so that's why you've got it down 70%. So I think that was part of the learning curve for a lot of people, is realizing, that Bitcoin was this kind of great shiny object that was going to, disrupt the world. I want to only be paid in it. But, they weren't around for the last crypto winter where, prices were down, 70, 80%. So I think to answer your question, those people that top ticked, that just basically got themselves a 70% pay cut.
So, and let's kind of end with that, if we could. One more question. So in your world, because we now have added the IDEX product to moderate growth and growth portfolios between last week and this week, but people are scared because it's gone from 60 something thousand of Bitcoin to 20. That's down by 2/3 basically. But we're not riding that because you're taking limited risk. Explain that to the average person so they know that we're not just stocking up on something that might go down still another 50.
Yeah, no, exactly. I mean, our approach is to be very respectful of the risk in this asset class. And so, everything we do is all model driven. And what we're looking for is we're looking for conviction buying momentum. And so, if you go back to actually October of last year is when we started to see, some waning conviction. And so we started raising cash, we raised more cash. We've been entirely in cash, for the last month now, kind of sitting out of the sidelines. And so, the idea is, we're not going to avoid all the drawdown, like you said, but, but in this case, since all-time highs, Bitcoin's down, 60 or 70%. We're down about, 1/3 of that. And so the idea is if you can, capture, more than 50% of the upside and participate in less than 50% of the downside, you've got an asymmetric payoff. So you're getting more than half of the upside when it goes up, you're getting less than half the downside when it goes down. And over time, you get participation to the asset class, but it should be a smoother ride. It's expected to be, your capital is expected to compound more efficiently. The idea is that you're not going to have to endure these, 50+% drawdowns. The volatility profile of our fund is expected to be, something more in line with like commodities. So again, I don't want to give the impression that there's no volatility or that there's going to be no drawdowns, but, it shouldn't be, 50, 60, 70% drawdowns. It should be, 10, 20, 30% drawdowns.
I get it.
And
on your word that you used the phrase crypto winter, I've heard that on TV. What does that mean?
Crypto winter was, just kind of the dormancy period after the 2017 crypto boom. 2018, crypto was down 80, Bitcoin was down 80%, and it stayed there for a while. Back then, crypto was still relatively new. You didn't hear about it on CNBC. All these use cases I've talked about were still academic. Nothing really had been developed of note, or if it did, it wasn't getting scale yet. So I don't think it didn't have nearly the adoption we have now. Now we've got, dozens, or not dozens, but we've got, several, Bitcoin ETFs, mutual funds. The institutional adoption is there. So I don't think we're in for a prolonged crypto winter like we were last time. But it's come to be known as kind of a moniker for the industry that when, when crypto prices get down this much, everybody starts screaming crypto winter again. So
just yesterday or the day before, I noticed that one of your competitors created an ETF that shorts Bitcoin.
Yeah, that's a tricky one. We've had a lot of people that have been in our models, from day one when we started opening it to outside capital in 2019, and so that they've seen them, perform well, and they say, can't you just invert your model? We want a short version. Shorting is very difficult. In an asset class like this, where there's huge upside volatility. One of the things that's interesting about digital assets is that there's a lot of upside volatility. So that if that means, it can rise 20% out of nowhere. And when you're shorting, it's easy to look at an environment like this and say, wow, we could have made so much money if we'd been short instead of flat. But you've got to, it's tricky. It's tricky at the turning points, because that's where, these short only funds can erode a lot of capital. So yeah, I'd be there's a place for short Bitcoin ETFs to be sure. But it's tricky. I wouldn't just, if you're bearish on the asset class, it's like the VIX ETF, where, it's the mechanics are a little bit detached from, how the actual ETF performs. So yeah, it's a wild ride to be sure.
Well, we've been talking with Ben McMillan, and hopefully everybody understands this conversation. And if you didn't, play it again. It might take you 2 or 3 go-rounds on here. Super bright guy, one of the brighter guys on the street, London School of Economics on econometrics. Great background, founder of IDEX. If you need to reach me, I'm at 925-314-8503. And then I think by now you've got my email, and the website is www.prosperityfinancialgroup.com. There's a Calendly program to make an appointment. So Ben, I want to thank you very much.
Thank you, Elliot. It was great doing this.
Thank you so much. And don't hesitate giving us a call, and we look forward to seeing you again. Thank you.